Today I'm going to talk about what happens if you make an overpayment to a pension scheme. Quite often we're asked, well, can we get the money back out? And with most things, pensions, it depends. There's two real different areas of what we call overpayments. So let's talk about the first one, which is one that you can get back out. When contributions are made personally in excess of someone's relevant UK earnings, then it is actually possible to get a refund. However, you have to wait until the end of the tax year so that know what the full earnings are, and then go to the provider and ask them if they're able to process this refund. Any tax relief will have to be paid back to HMRC, and if the individual has claimed any tax relief themselves, so if they're a higher or additional rate taxpayer, then they need to make sure they adjust their tax return to make sure that that is paid back. It is possible to go back a few years, so if this has happened and they've discovered that they've paid too much and not technically been eligible for tax relief, that's what this is all about, then you can unwind it on that basis. Even if the scheme has moved in the meantime, it can be possible, but you need to talk to the scheme as soon as you possibly can to make sure that they're aware and to see what their policies and processes allow to ensure that they can be done. So the other one we get asked about is exceeding the annual allowance or the tapered annual allowance or the money purchase annual allowance, whichever annual allowance you're testing. Unfortunately, in these cases, there isn't anything you can do. You can't actually get a refund. So if they go in and they overcontribute, even if it's by poor advice, unfortunately, then it's not something that can be unwound. The contribution itself, unless it's gone over and above someone's personal earnings and has been a personal contribution, is a perfectly legitimate pension contribution. And that's actually all HMRC care about. Is it a legitimate pension contribution? If it is, it's tested against the annual allowance and the appropriate charges would apply. So the next thing you need to consider is whether or not there's an annual allowance charge. Well, first off, you need to do carry forward. Check out the carry forward calculations. I've done a short one of these, just a reminder on carry forward, just the things to think about and the things that it works. But make sure you get the information, stick it all in a decent calculator, and make sure that you've worked out whether or not they have actually exceeded it after carry forward. The important thing is there is nothing to declare unless you've exceeded the annual allowance, including carry forward. So once you've factored all that in, you only declare to HMRC if you've actually got a charge, and that's the important thing. Do remember that if you are declaring a charge, that it's still important to make sure any additional or higher rate tax relief is also reclaimed if appropriate. So it depends on the type of scheme. So if it's a net pay scheme, there won't be anything else to reclaim because all the contributions would have been paid out of gross salary. And if it's a relief at source scheme, then that will need to be reclaimed if they are an additional or a higher rate taxpayer, because the scheme itself will reclaim back 20% and 20% only. So make sure that that's claimed. If you don't get all the personal tax relief that's entitled, then technically you will be in a negative, where the annual allowance charge itself is there to recoup tax relief. So it should net out, give or take a few quid, to make sure that basically what you're doing is you're not getting tax relief, but you're not paying additional tax other than that. Lots of people say, well, I am paying additional tax because all the contributions were employer and I've gone over the annual allowance and I'm getting a tax charge. Why is my employer not getting a tax charge? Well, effectively, pension contributions are salary by any other name, but they actually got additional benefits. So if they weren't putting it in your pension and they were giving it to you, you'd be paying tax. So by putting it in your pension, you're automatically, in theory, getting tax relief. So that's why your client is liable to the tax charge, not the employer. The employer's tax relief that they get is actually a business expense. It's nothing to do with pensions tax relief at all. All contributions made and all salary made and things like that are all business expenses for the purposes of running their business. So they're not actually pensions tax relief, so they're not connected as such. So there are a couple of options when you've gone over and above the annual allowance. There's obviously pay the annual allowance charge out of your own pocket. So the member declares it on their tax return and they just literally put in the amount that they've gone over and the tax charge will fall when they do their tax return. The alternative is to use scheme pays. And scheme pays falls into two categories. There's mandatory scheme pays and voluntary scheme pays. The main difference between two is whether or not the scheme has to do it. It's all in the name, mandatory. So mandatory scheme pays applies if the contributions made to that individual scheme is over 40,000, so over the standard annual allowance, irrelevant of whether or not the annual allowance is tapered or the money purchase or anything. It's only applicable for mandatory annual allowance and mandatory scheme pays if you're over and above the 40,000. and the tax charge itself is over and above 2,000. So that's how mandatory scheme pays works, in which case the scheme can be required to pay that tax charge. They are only required to pay the bit over and above the 40,000. So that's also worth noting. So if you've got a £10,000 or a £4,000 annual allowance, for example, then and you've put in 50,000, then they're only going to pay the annual allowance charge on the over and above. It doesn't mean they can't. So voluntary scheme pays is as it says, it's voluntary. Dear Mr. Scheme, will you pay my annual allowance charge? Yes, I will. Voluntary scheme pays kicks in. There's another couple of differences there. One is deadlines and reporting requirements. So the deadlines and reporting is longer for mandatory scheme pays. You've got a longer timescale in order to get the scheme to agree to pay it and for them to pay it across. Voluntary scheme pays, it still remains the responsibility of the individual. So in theory, voluntary scheme pays should be done and paid alongside the same timescales for self-assessment. So what we should be seeing today, if anyone's got voluntary scheme pays for last year, that they should all been agreed, and it should actually basically have been put through by the end of the tax year, so at the end of the tax reporting. So by the 31st of January. Any late payment charges could then apply in theory. So you can have late payment and you could have interest if the scheme turns out not to actually pay it and you have to pay it at a later date. So just bear that in mind to make sure that things are being met at the appropriate time. So reporting these to HMRC, so again, it depends on which you're doing, depends on what you need to put in the form. So the paper form is the SA 101, which is the additional information for the self-assessment. If you're doing it online, then you tick the box for pension savings tax charges, and what it will do is it will bring up the questions about that. There are pretty much 3 boxes that need to be completed. So the first one is how much have I gone over and above the annual allowance after carry forward. So what is my tax charge charged on? So that's the actual amount. So it's not the tax charge itself, it's how much have I exceeded the allowance. So that's all you need to do if you're going to pay the tax charge. The individual's going to pay their tax charge themselves. If they're using scheme pays, then there's another couple of boxes. So the next one is how much is the scheme going to pay? So that's how much tax charge. So what's the physical amount that the scheme has agreed to pay? And then the other one is what's the scheme's reference number? Really important, so that HMRC can tie up the money coming into them from the scheme and the money that it is being said they're going to pay against the tax return. We have seen cases where people have got these numbers wrong. Many companies have multiple scheme numbers. So if you've used one for one client and it sounds like it's the same, I still urge you to check it to make sure that it is the most appropriate one. If you've asked them about scheme pays, then they should have told you what the scheme reference number is, and that will hopefully bring it across and you'll be able to actually utilise that. But it's really important. Anybody who doesn't do a tax return and has an annual allowance charge will need to request a tax return for that basis. There isn't another way to report it. So make sure that they get in there, because anyone who's set up a new tax return and suddenly gone to self-assessment will know it can take some time, and it's not something you want to try and be doing sort of on the 30th of January or the 31st of January, because you need bits of paper in order to get that set up. So to avoid any tax charges, try and address it early. In exactly the same way as I always say, try and speak to the schemes early. Speak to the schemes early to see what they're willing to do, because a lot of them are more flexible than you'd think. And unfortunately, the odd one is less flexible than you'd think. When you think this is easy and they'll do scheme pays, that they don't necessarily. So understanding that is key to ensuring that if they've gone over and above, it can be dealt with in the easiest way. The question whether you should or shouldn't use scheme pays is an interesting one, and for most money purchase schemes I would generally say it's a no-brainer. Why wouldn't you want to pay a tax charge out of a tax relief pot? Why would you want to pay a tax charge out of money that you've been taxed on? It's surely cheaper one way. When you're talking about defined benefit scheme pays, then there can be more arguments either way, depending on how much they charge you in order to pay that. But 9 times out of 10, it tends to be better for the individual on the sort of deferral of actually having to put their hands in their pockets to actually use scheme pays. But there's lots of different moving parts when you're talking about DB schemes. So it's always worth considering at different points what's best for the client. And so advice is key to get that there. Well, hopefully that's given you an idea of what can be done or what can't be done, and what you should speak to schemes about. I mentioned carry forward, and I've done a brief talking head here about carry forward, and just a reminder of things to think about and the different areas. But we've got plenty of other information, and there are other videos with much more detail about how some of these things work. So do have a look in Techlink, and I'm sure there'll be there something to help you. Thank you very much.